Welcome to the Nichols Tax Update podcast for October 5th, 2020. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and occasionally expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I acknowledge the value of my subscription to Tax Analysts and Tax Notes Today, the preeminent source of information for tax professionals in preparation for this program. In fact, we've got I quote an article on partnerships extensively in this program, so stay tuned. What's in this edition? Everything. 9 items. A charity's website gets it in trouble. Link to an online job placement service creates unrelated business income. Next, who's a partner? Nationally recognized tax commentator Lee Shepard discusses changes in the law in response to tax shelter design. Who's a partner? What's a partnership? A discussion next on an unusual grant to a public charity, definitions and measurement of an unusual grant and what it means. Final regulations for withholding on periodic payments from retirement plans. You'll be surprised by this one. And then a case involving a rental loss where the taxpayer, an individual, attempts to claim a rental loss 3 different ways, but no, that doesn't work. It's a trade or business requiring participation. It's not a rental loss under 469 at all. It's a trade or business. We'll talk more about that. Final regulations on deductible entertainment expenses. No surprises here. We'll review the 9 exceptions. And then 3 fact sheets on how to shut down a business without tax trouble. I wonder why. Given the economic upheaval of the COVID and of the other circumstances, with a lot of businesses shutting down, it's important that we take a look at the IRS guidance on how to take care of your tax obligations when you're shutting down a business. The IRS policy on net operating loss refund claims. Refund first, ask questions later. That's a new one. Finally, both the debtor and her attorney must provide Forms W-9 to the bank in order for the bank to meet its statutory obligation to report the payment of $20,000 to the debtor's attorney, who has income from that. As I said earlier, stay tuned. Now, this is a technical advice memorandum. This charity is under audit. They've submitted this question to the IRS for resolution. What is the government's position is always the question when you go up for a technical advice memo. So here, the charity has agreed that the online placement service in question is regularly carried on. It's a trade or business, and it's not related to the charity's exempt purpose. However, the charity argues that placement and related services were not conducted by the charity, but by a vendor that hosted and managed the online placement service, which was only linked to the vendor's website. Income the charity received was royalties from the vendor's conduct of the online placement service and should therefore be excluded from UBI. You think? Is that how Section 512B2 works? No. The subject income was mostly from fees paid by users of the online placement service, as well as advertising, rather than licensing the charity's website, trademarks, or members list. That means income from the online placement service is not a royalty payment from the vendor to the charity. It's not excludable as a Code Section 512B2 royalty modification, and it is unrelated business taxable income under Section 511. Of particular interest here is that this entity had operated a job placement program for more than 40 years. But when they took it online, developed a web application which they couldn't manage, entered into a contract with a vendor that linked to its website. This enabled the vendor to conduct a trade or business under the auspices of the charity. The share of income the charity got was from the active conduct of a trade or business. That hurts. Who's a partner? One of two. Commentator Lee Shepard in Tax Notes Today on September 28th. Tax advisors often try to use the pass-through rules of a partnership, or an S corporation for that matter, to engineer a tax shelter product in which loans are classified as capital contributions with guaranteed cash flow and little business risk to one partner, while other partners, the tax shelter investors, are allocated substantial losses with relatively small investment and no risk. The article cited above is a comprehensive discussion of the state of the law on such arrangements and contains a clear caveat to avoid them. Code Section 704E1 was used to determine a partner status. Combine that with leading court decisions that focused on partnership validity, and you had a toxic soup of risk. Ms. Shepard suggests that legislation is needed to provide certainty for gifts of interest in family-limited partnerships and true partnerships where tax attributes can be allocated among real partners and shams can be clearly avoided. Note the 2015 repeal of Code Section 704E1 was accompanied by adding identical wording in a new Code Section 761B. So the code still focuses on allowing a family member to become a partner with a gifted interest. Next, large cash contribution is an unusual grant. This is a letter ruling. The grant to in this case, a fraternity's charity, was not expected. It is unusual when compared to the size of donations normally received. The funds are to be used for major repair projects to chapter houses, promotion and preservation of the fraternity, promotion of the Greek fraternity system in the context of undergraduate education, preservation of the central office staff of the fraternity, and finally, emergency or urgent circumstances. The donor agreed to a total gift of an unknown amount of dollars, but it's a large amount, to be paid in 5 annual installments. So what is this thing, this unusual grant, and why do we care? Treasury Regulations, Sections 1.170 Cap A-9 F6 2i and the accompanying 509 Reg set out the criteria for an unusual grant, the amount of which is excluded from both the numerator and the denominator when you're calculating the 33 1/3% of public charity support test. It applies to substantial contributions or bequests from disinterested parties which, 1, are attracted by reason of the publicly supported nature of the organization, 2, are unusual or unexpected with respect to the amount, and finally, would, by reason of their size, adversely affect the status of the organization as normally being publicly supported. You've got this fraction, the numerator and the denominator. The unusual grant would screw up the 33 1/3%. And so you remove the amount of the unusual grant from both the numerator and the denominator so that you don't skew and adversely affect the charity's publicly supported status. Final regulations on withholding on periodic payments from retirement plans. This is the withholding on payments from an annuity and an IRA. Final rules are just like the proposed rules. And the promised default rate is still under review between the IRS and the tax community. So the withholding default rate, when no withholding certificate is supplied, will continue to be the rate for a married taxpayer with 3 claimed exemptions. We've been through no regulations, then Then we had proposed regulations. Now we have final regulations, all leading to no change in your practices. You can't make this stuff up. Next, Ronald Lucero was disappointed that his rental loss was not deductible. When he was under audit and not before, he scurried about collecting receipts, calculating the hours he spent supervising one short-term rental property. He reconstructed a log. He presented all kinds of information regarding his participation for 275 hours or 264 hours. But a management company did all the work. This is a lot like the vacation condos in the Carolinas, where investors have been encouraged to buy a condo, which is going to be rented, and management companies have sprung up, of course, to take care of all the details. So the investor gets an accounting and gets income, but really doesn't have any work to do on renting out the apartment. All of Mr. Lucero's efforts were to no avail. The property was not a rental anyway. It was a trade or business. It was not a vacation home. The participation requirement is substantially different. You have to have material participation in a trade or business in order to deduct the loss. So Mr. Lucero has a suspended passive activity loss. Deductible entertainment expenses. What a bunch of Sturm and Drang we've had on this. What is and is not. These are the final regulations. They still allow for partial write-off of business meals. They provide guidance to determine whether an activity is generally considered, and that's in italics with a question mark for a reason. We'll come back to that in a minute, to be entertainment. 9 exceptions in section 274E continue to apply. So why is generally considered in italics? Because it indicates the availability of an option. What is generally considered by one revenue agent may not be generally considered by another. What is generally considered by me may not be generally considered by the revenue agent that's auditing this activity. So the final regulations still leave the door open for argument about what is and is not, where is the line, what's deductible, what's 50% deductible. The final regulations do not close the door on anything. Leaving that phrase, generally considered in the regulations, leaves a lot open. What are those 9 exceptions that are in Code Section 274E? There they are on the screen. You can read those faster than I can read them to you. There's no change. They're the same. They've been there since Hector was a pup. Some of them are 50% deductible. Some of them are 100% deductible. It depends on the circumstances in which the expenses were incurred. How do you shut down a business without tax trouble? The IRS produces 3 fact sheets. One for a Schedule C trade or business, one for a partnership, and one for a corporation. These fact sheets detail the steps to take when you're winding up a business. They're the same for all types of business in some ways, with differences based on the type of business organization. For example, all types of businesses must file final income and payroll tax returns. All types of businesses must advise IRS entity control in Cincinnati that they're going out of business, and you shut down and you give up your tax ID number. Only corporations, whether C or S, must file Form 966 and adopt a plan of liquidation. This is, and then pursuant to that plan, assets are sold, liabilities are paid, and all shares are redeemed. Partnerships make final allocations, dispose of the assets, pay the bills, and distribute the partners' capital accounts. What is the IRS policy on NOL refund claims? They've got a ton of them, a blizzard of claims. Speaking in a webcast sponsored by the California Society of CPAs on October 1st, a revenue agent said this: the IRS's approach to refund requests, whether on Form 1045 or Form 1139, is to refund first and ask questions later. But refund first means it's going to be at least 90 days. If you have a client with a refund claim, get it in. The IRS is going to honor the NOL refund claim without examination, without a lot of questions, but they reserve the right to come back and ask a lot of questions later. In this one, Christine Coppola, both the debtor and her attorney are required to give the bank that's paying out $20,000 to the attorney a Form W-9. The debtor, her husband, two individuals, and her attorney must provide Forms W-9 to Wells Fargo Bank regarding a settlement payment of $20,000 to be made directly to the Coppola's attorney. The debtor and her husband can argue to the IRS that the payment was not income to them, but the bank has no stake in that decision. The bank has a statutory obligation to issue the Forms 1099. As support for that, the bank cites Gerbellini Rosa and CIR versus Banks, two court decisions requiring a payor to issue forms not to determine who has taxable income. Well, it all ends too soon. Until next week, for the South Carolina Association of CPAs, stay safe.